Good morning, everyone. It's Mick O'Brien here. I'm the Managing Director of EQT Holdings Limited, and welcome to this investor presentation to talk about the company's results for the year ending 30 June 2018. I've got with me Philip Gentry, our Chief Financial Officer and Chief Operating Officer. This morning's agenda, we're going to go through a review of the year. Philip will take us through the financial results of the company, and then I'll come back and talk about a strategy update and the outlook for the company, and then we will take questions at the end. So the 2018 year in review, we had really strong improvement in performance. Our net profit was up 28% to 19.7 million, so we're delighted with that result. The prime driver of that was revenue being up 11%. We continued with disciplined expense management, with expenses up 3.8% for the year. And a key driver of revenue, obviously, is our funds under management, advice, administration and supervision, and that was up to a record level of $86.2 billion, so a 21% increase in our funds under supervision. The basic earnings per share was up 26%, in line with the NPAT increase, so to 97.3 cents. The total dividend for the year is 82 cents, so the board have decided to declare a dividend of 42 cents for the final dividend of the year. That's an increase of 2 cents on the interim dividend, and all in all, the full year dividend of 82 cents is 15.5% increase, so a good reward for shareholders. Importantly, all areas of the business have been experiencing really strong growth, so that's a particularly pleasing part of this set of results. And likewise, importantly, we've been delivering to all of our stakeholders. So I'll talk further about how we're improving our client service, the engagement of our employees, obviously these shareholder results, and also our impact on the community, and that is such an important part of this company. So the momentum has been building. I mentioned before, really, that this business is this result has been underpinned by really strong performance in each of the lines of business. So a really significant improvement in trustee and wealth services, and that comes from both the private client side of the business and also from the superannuation part of the business. We've seen continued, consistent, good performance for corporate trustee services. This is a part of the business that has had strong performance over many years, and that's continued in the FY18 year. All of the acquisitions and partnerships that we entered into during the course of the year have delivered for us. So the Sandhurst acquisition from the Bendigo Bank, which occurred the prior year, we've had their first full year of this, and it's performed exactly as we expected. So it's absolutely core to our business, and very comfortable with how that's progressing. We took a majority shareholding in UK-based Treasury Capital Limited, which gives us the opportunity to expand globally in providing fund governance services. That business is only just up and starting, but the results are promising so far. We're appointed as the superannuation trustee to the Aon Master Trust. That effectively doubled the scale of our business and really proved out our model for providing superannuation trustee services. And finally, we acquired OneVue's responsible entity business late last year and completed that earlier in this calendar year. And that really, just cements Equity Trustees' position as the leading provider of responsible entity services in this market. The industry environment has been favourable to us. There's no question of that. The dynamics around, diversified financial services groups and people looking for independence and looking for specialists throughout the value chain is very positive for our business. And the result in relation to our staff engagement, I'll show you a little bit later, has been excellent. It's a result we're very proud of, because building the staff engagement is so important to getting our client satisfaction right, and which will be an increasing focus for us in the year ahead. Let's just look at the growth in funds on this slide. So you can see on the left-hand side, Trustee Wealth Services funds under supervision grew by 36% in the year. A lot of that on the back of the appointment into the Aon Master Trust, but there was good growth even taking that out of the number. So really strong, consistent growth in TWS. In corporate trustee services, we had an 18% growth in funds to just over 70 billion, so we're at $71 billion. If you look at those numbers, those funds have doubled over the course of the 4 years, so that's a 19% per annum compound growth rate. So, as I mentioned before, very consistent growth in corporate trustee services where we clearly lead the market. If I just break down the Trustee Wealth Services results in a little bit more detail, and again on the left-hand side we have what I describe as our core trustee services, and you can see there a really solid increase in estate management. That's quite a variable number because the types of estates that come to us can vary significantly, and they change over the course of a 12-month sort of cycle. Testamentary trusts, we started 33 new trusts, but a number of large trusts vested through the course of the year, shifting into other lines of business. And perpetual charitable trusts, which is a very key part and the largest part of this part of the business, again grew strongly. We started 7 new perpetual charitable trusts, which was a 1% increase on the previous year. If I look on the right-hand side, we've said that we are increasingly trying to grow our footprint into different other trustee markets and community trusts. So that's trusts looking after primarily Indigenous communities is an area that we want to build significantly, and we've had a small increase there. We have got an appointment into a new trust which comes on board in a couple of months, so we'll continue to see growth there, which we're very happy about. The living donor business, as I've said before, our philanthropy business has been primarily focused in testamentary philanthropy, but increasingly our focus is on business development in the living donor space, and we're starting to see some excellent results with 13 new clients coming on board through the course of the year. And you can see finally there on the right hand side the really strong performance in compensatory trusts. That's been a focus over the course of the last 18 months and will continue to be a focus, and we hold a good position in that market. If we look at the highlights in corporate trustee services, to some extent it has been more of the same. The number of funds managers that we provide services to has increased to 137, so a 24% increase. And the number of funds, so this is the activity of our clients, the funds have increased to 296 funds that we provide responsible entity or trustee services to, so a 12% increase. And you can see some examples of the names of the new clients that have come on board through the course of the year, a very good mix between both local names there as well as global funds managers, and those global funds managers have come from a variety of areas: South Africa, New Zealand, the US and UK. I haven't noted down there the various asset classes and strategies being adopted by these managers, but it's fair to say it's a very diversified mix of asset classes, which puts this business in a good position. Let me talk about clarity of purpose, and I've talked before about our T6 targets, but you can see that's now reduced to T4. And what we've tried to do, we've been operating to those previous targets for the last 2 years, and I guess over time we've looked to modify and refine them so that they really resonate with our staff primarily, but also with the market more broadly. And these 4 targets really hit each of our key stakeholders. The first one is our clients and improving their satisfaction with our services. The second one, lifting our employees' engagement, and I'll walk through those measures shortly. T3, growing our shareholder value, and finally T4, deepening our community impact. So really this organisation is very focused on delivering to all of our stakeholders in a very balanced way. If I look at client satisfaction, we started measuring client satisfaction 2 years ago. Our Net Promoter Score was maintained at +12. It would have been nice to see increase, but +12 on its own is very positive versus many financial services organisations. Pleasingly, our Net Loyalty Score, which is the propensity of clients to purchase another product from us, increased quite substantially. So we're happy with those results. This is a key area of focus for us going into FY19, how we improve the client experience, how we digitise parts of the client experience and improve our reporting and the service capability of our staff. If I move on to T2, lifting employee engagement, you'll see on the left-hand side there engagement levels and the right-hand side enablement. So this is our staff assessing themselves about how engaged they are in the organisation's vision and strategy and how enabled they are to get on and do their job. And we need both of those to be in place for them to be effective. And you can see over the course of the last couple of years, we've really made great inroads on engagement levels, and we're now just sitting just under the industry norm, which is on the left-hand side there. Pleasingly, on the enablement side, we're now well exceeding the industry norm, and we're delighted with that set of results. Our focus has been on training, our remuneration and benefits that we provide, collaboration amongst the teams and within the business, and performance management. And it really is starting to show great results. And it's important that we get this right, because it's these clients that provide the service it's these staff that provide the service to our clients, and this is a precursor to getting our client satisfaction levels up. Growing shareholder value, and you can see there earnings per share growth this year, as I mentioned before, has been really strong at 26%, on the back of last year where it was 16%, so it's a really solid progression. On the right-hand side, a key driver obviously is our funds under management, advice, administration and supervision. And as I mentioned before, they're up over 20% to $86 billion. So we are really pleased with those results. And finally, deepening our community impact. We granted, through the course of the year, just over $80 million of funds to charities and not-for-profits. About 70 million of that was through our philanthropic granting, the rest through granting from estates and various trusts and the like. And you can see the distribution of that granting in the middle, the bulk of it going into the health area and followed not far behind by human services. So this is where our company can make an enormous impact on the community. It's an area of the business we want to grow, both from a point of view of the commercial aspects for the company, but also the impact that we can make on the community. We grant to more than 2,000 beneficiaries through the course of the year. I should also say through the course of the year, we implemented a workplace giving and volunteering program from our staff. And while that's just started, we had more than 10% of our staff participating in that last year, and looking for a really solid increase in that next year. I'll now hand over to Philip to take you through the financials.
Thank you, Mick. Let me now provide a bit more detail on the financials, and let's start with the profit or loss summary here. In this slide, you can see that total revenue growth year on year was 10.8%, which was particularly strong and driven by a number of dimensions, and I'll talk more about each of these shortly. On the on the expense front, you can see the breakdown there between operating expense growth of about 7.1%. This was in part due to the acquisitions, a combination of Sandhurst, OneView, TCL, and also the Aon appointment, which all required a certain amount of investment. The non-operating expenses, you can see, are well down, and combined the expense increase was a more disciplined 3.8%. You can see also that there was a significant increase in the net profit before tax margin to 32.4%, which we were very pleased to create. And of course, a strong increase in the net profit after tax and dividend. Now turning to the half-on-half performance, and just looking back over the last 6 halves, the purpose of this slide is just to illustrate the turnaround that's quite evident going back a couple of years, and then perhaps more importantly, the consistent improvement over the last 4 to 5 halves in each of those dimensions: revenue, net profit, EPS, and dividends. And now let me turn to breaking down the composition of the revenue growth so we can see exactly where it's come from. In this slide, you can see the bridge for revenue here, and you can see that 10.8% headline growth is driven by 3 key sources. The actual underlying organic revenue growth was about 4.9, which compared with recent years is actually quite strong for EQT. There's about 4% market growth, and then a significant revenue contribution from the various acquisitions you can see there, which more than offset the single client exit, which we've talked about previously. And then on non-operating expenses here, just a little more detail. perhaps just drawing your attention to the bottom of this chart where you can see going from right to left, circa 8 million in 2016 of non-operating expenses, down to 1.3 this year, and the majority of that was related to the M&A activity that we had during the period. So a significant improvement in non-operating expenses, and we expect to maintain that. Now turning to cash flow, here you can see that on the left-hand side there, you can see 31.8 million of pre-tax cash generation. We're a very strong, consistent cash-generating business. Cash has been principally used to fund acquisitions, some office fit-out, tax payments and dividends. It's a pretty clean cash statement. And then on the far right-hand side there, a material increase in the cash on hand, the majority of which is used for regulatory capital purposes, but we also have a healthy surplus. And now let's turn to each of the businesses in a bit more detail. Firstly, with Trustee Wealth Services. And on the left-hand side of this chart, you can see their own revenue bridge, and you can see 11% headline growth in revenue, which was supported by a full-year contribution from Sandhurst Estates and positive markets, and a pretty healthy 5% underlying organic growth, and assisted in particular by the Aon trusteeship appointment. And just remember, in relation to TWS, a significant amount of that revenue growth is not quite so straightforward, particularly in perpetual charitable trusts, where effectively those clients have passed. Really market growth is all we can expect on that particular part of the business. So the headline revenue growth and the underlying organic growth indicates that the rest of the business is going particularly well. Now turning to the Corporate Trustee Services performance. Again, a similar bridge on the left, just breaking down the components of revenue there. The pieces driven by the acquisitions and the organic growth. And then on the right-hand side, the pretty healthy increase in the funds under supervision. You can also see there the breakdown of the composition of asset classes and the very significant global character of them, both in equities and fixed interest, that is part of the portfolio. Turning to the balance sheet, again, a pretty strong balance sheet. You can see there's quite a strong cash and liquid investments position. I'll touch, but most of which is required for regulatory capital purposes. I'll touch on that in a bit more detail shortly. Very low gearing, substantial headroom in our covenants, and quite reasonable surplus borrowing capacity, which gives us the flexibility to take advantage of any modest growth opportunities in the future. And now to the capital position. As I said before, we comfortably meet our reg cap requirements. Over the next 3 to 6 months, we will be transferring the ex-OneVue RE clients to our Equity Trustees Limited licensed entity, and that we expect that will release circa 3 million of capital over that period. And in the medium term, there's another opportunity to release about a further 5 million, but that's got more like a 12 to 18 month time frame on it. You can also see there that our dividend policy is to pay out 70 to 90% of reported NPAT, and in this particular year, the 82-cent payout comes to about 84%, or comfortably within that payout range. So in summary, very strong revenue growth, disciplined expense management, healthy enhancement to our operating margins, and a significant increase in NPAT and dividends. The benefits have flowed as expected from our corporate restructure and operating model review, which we undertook some 12 to 18 months ago now. The various strategic initiatives are all delivering well, and we expect them to be comfortably single-digit accretive in FY19 taken as a whole. And we've got a strong balance sheet and the capacity to support our growth plans. Let me now hand back to Mick to take you through the strategy and outlook.
Fabulous. Thank you, Philip. Let me update you on the strategy and the outlook for the company. So firstly, this hasn't changed. Our clear single-minded purpose to be Australia's leading specialist trustee company. The key point there is that everything we do is focused on this. All of our capital is put towards this, our efforts are put to it, and our intellect is put to it, and it is really paying off. You can see the global picture there. Whilst we've expanded offshore for the first time, it's still a very small part of the business, so we think this single-minded purpose still stands us in good stead at this point. Favourable industry dynamics. I've talked about this before, but our business is underpinned by very positive dynamics. So firstly, the demographic dynamics. The fastest growing demographic segments in Australia are the older age cohorts, and generally our services and products are delivered into those groups. Our corporate trustee services line and superannuation line is really underpinned by the growth in superannuation assets, which again is growing at a real rate over and above GDP. The trends have really been boosted by the industry transformation that's occurring. We're seeing increasing demand for our outsourced specialist trustee model. The financial services industry has concerns generally about independence and conflict management and specialisation, and really being a specialist independent trustee is being looked on by more groups as a potential solution for some of their issues. And finally, the global expansion into the UK and also into Ireland opens us up to the global funds management market, which I'll remind people, is US $70 trillion in funds, and being driven by some of the same regulatory change that we see here in Australia. And we see a good opportunity for cross-selling and leveraging our existing global client base in corporate trustee services. Now, we have, as I mentioned, an unwavering focus on trust, governance, risk management and fiduciary responsibility. This is our core business, and we apply that in whichever markets we can where trustee services are required. We think our proposition is valued more highly than ever in today's environment. We can be a trusted partner to our clients and other partners. We're not conflicted with their businesses, and we're specialised in our particular part of the value chain. And we fulfil an incredibly important role in the industry in representing the interests primarily of investors, unit holders and members of various collective investment vehicles, managed schemes and superannuation funds and trusts. So it's a position that we take very seriously. The advantages of our model for clients and partners are that it gives them access to professional specialist expertise. It's a best practice model in governing funds. It assists in achieving structural independence and reducing conflicts of interest. It simplifies their business and enables a focus on their core business. It allows them to be responsive to current issues, reduces the overall risk in their business, and generates efficiencies and cost savings. So there's no question it's a compelling proposition for many financial services groups to look at. I want to just quickly talk about our commitment to reconciliation. During the course of the year, we launched our first Reconciliation Action Plan, which was endorsed by Reconciliation Australia. And the idea of the plan is basically to build capacity and empower Aboriginal communities to increase their participation in the management of their own wealth. So we're heavily involved in the sector, managing more than $50 million of funds for different communities, and also granting around $2 million a year in philanthropic grants to various causes that are aimed at assisting our first Australians. So we're proud of this. It's going to be a focus of the organisation, has a commitment from the board and from the executive and our staff to provide the services that we can to assist our first Australians. We'll just talk quickly about developing our data and digital capability. So this is really important and a focus for us in FY19 to continue to improve on our client satisfaction levels. So the key things that we have planned is to enhance the client experience. So that's improving the databases that we use, the CRM tools that we use, and importantly, the practice that our people use in delivering service to clients. We have been piloting robotic process automation. We see plenty of opportunities to use that in many parts of the business to improve our efficiency and delivery of service. Two areas that we are focusing on is estate management and estate planning. Estate management is a key area where we are introduced to new beneficiaries in the organisation. It's a complex area. It's sometimes a frustrating area for our clients and for beneficiaries. It's an area where we think our automation of service and process really will deliver benefits to our clients. And finally, will bank digitisation. We have a will bank of more than 50,000 wills, and To this point, they have been really hard copy wills for the most part, and we are in the middle of the process of digitising all those will banks, which again will allow us to service those clients more professionally, to ensure that we are able to cross-sell our other services to them, and to be able to interrogate that data really in detail for the first time. In TWS, our focus is going to be in a number of areas. I mentioned estate planning before, where we're digitising our will bank and looking to improve the service to those clients. Estate management I also touched on. In trust management, we want to focus in our specialist areas, compensatory trusts and community trusts, where we see great demand for our services and feel that we have the people to deliver in those areas. We've been experiencing really high client satisfaction levels in our advice business, and again we're looking for greater cross-sell opportunities of other products and services to that client base. In the philanthropy area, our focus is on the living donor space, and we think we can capitalise on our estate planning activities and advice relationships to build that philanthropic business. And finally, in funds management, we're continuing to invest in strengthening that team and capability, and we'll talk more about that in coming months. In superannuation trustee services, really our focus is making sure that the strength of our model is well understood by the market, so people understand how the process works, the expertise that we have, and the enormous experience we have in taking on appointments of trustee roles in superannuation, undertaking successive fund transfers for different funds. We really have had a program over the last 3 or 4 years that has been second to none. Our proposition here is partnering with superannuation providers to provide the trustee services that are not core to them, and allowing them to get on with the promotion and distribution of their superannuation offers. The appointment of the AO Master Trust was fabulous doubling of scale in the business, but importantly proves out our model and really is a classic example where we see the market in superannuation going in the future. If I turn to corporate trustee services, our first focus is in continuing to grow the existing business. We continue to see new managers coming to the Australian market, new startups of Australian managers. We're capitalising on the trend of the highest quality Australian managers entering the retail market. This is a trend that started probably 18 months ago. It continues unabated, that the very highest quality Australian equity managers are increasingly shifting to the retail market and therefore requiring RE and trustee services. We're utilising our service more fully in the superannuation space, where superannuation fund providers are wanting fund structures within their programs for various reasons, and we have a number of clients in that area. We're at the leading edge in terms of the CCIV regulatory change that is coming down the channel towards us. We've bedded down the OneVue client base really well, so we've got 28 new managed investment schemes there and $2.7 billion of funds under supervision. One thing that's not on this slide is that we participate in our first listed investment trust vehicle, and that is currently in the raising stage in the market, and we see that as another future area of growth for the business. We've put a greater emphasis in building in the structured finance area, so in securitisations, debt offers and real estate trusts. We've dedicated more people to that business, both in Melbourne and in Sydney, and we're starting to win business in that area, and very happy with the progress there. And finally, looking to grow the business offshore in leveraging our client base into other markets that are centres for collective investment vehicles. And we have been approved by ASIC to participate in the pilot of the Asian Funds Passport program. We're just talking about the global opportunity for corporate trustee services. I mentioned the size of the global market in funds management before. Our focus is in the non-US parts of the market, which is about half of that market. And we are focusing in those areas that are centres for collective investment vehicles. So Ireland, the UK, Luxembourg, and there may be some other locations as well. This is our first step offshore. We think the majority stake that we've taken in the business gives us all the access to the people that we need, the licenses that we need to compete, and the capabilities to build that business. So, in summary, we believe we are well positioned for growth. We've had a substantial lift in financial performance in the year just gone. Increases in NPAT, revenue, earnings per share, and the dividend have all been higher. The results have been built on fundamentals. We're operating in our core trustee space. The various acquisitions and partnerships have added value and have been very targeted and focused. We see good momentum and have a clear agenda for each of the parts of the business. We're really delighted with the results of the engagement in our workforce, because that will set us up for delivering better customer service to our clients. And we're looking to leverage our core strength as a trustee and a fiduciary in these very uncertain times. So it's an encouraging outlook for FY19 and beyond. So I'd like to finish there, and people can submit questions online. So I will take a pause, and we'll wait to see as questions come through. Thank you. We've got one question here, and it is: the revenue growth has been very strong, at 11%. Can this be maintained in future years? Look, that's a good question. In FY18, really everything went right for Equity Trustees. All lines of business performed strongly. There were no material client losses anywhere. We had no remediation or compliance issues to rectify. So that should be noted. Also, I think when you look at that headline 11% growth, bear in mind 4% of that is from the market, and that will be what it will be in the future. Some of it was from acquisitions and the partnerships. About 5% of it was from organic growth, as Philip indicated on his slide, and also
3.9 combined, mate.
3.9 combined. Sorry, yeah. Thank you. And it should be, as Philip also identified, a large part of our client base is from past clients that is locked in and can't be grown other than at market rates. So to get that type of growth rate is pretty sound. So I think people should bear in mind that it was really an excellent year in FY18. We have one other question here, and that is, are there revelations that are coming out in the Royal Commission hearings and also in APRA's report into the Commonwealth Bank that are issues for equity trustees, or is this positive for equity trustees? Well, look, firstly, the business of financial services and the business that we are in is complex, and issues can arise from time to time. But as a general rule, many of the points that have been coming out in the Royal Commission evidence are not issues that are evident in equity trustees' business. Our role is somewhat unique. We sit in the centre of as a governing body with an independent party in these arrangements. So often that means we don't have the same types of conflicts that other diversified, vertically integrated firms have. So we do see, by and large, that these trends are positive to our model, that people are considering that independence is highly valued and should be inserted into parts of the value chain, and also will reduce conflicts and introduce a specialty type expertise into the mix. So we're seeing wider appeal, and generally from larger groups than what we would ordinarily see. So by and large, it's a positive to equity trustees rather than a negative. Now the next question is, are there many more acquisitive growth opportunities in the market? Well, look, we will always be looking for opportunities, and there are some, I would say, smaller scale opportunities, primarily in different areas, but we are focused on our core trustee services. And there's one or two, I'd also say, in the sort of middle ranking area, and one or two at the very larger end. But again, we'll be opportunistic and also proactive in looking for what they are and adjacencies that would add value to the business overall. Another question. Hi gents, great result, thank you. Looks like the CTS operating margin has flattened. Should we expect it to fully plateau from here? Philip, do you want to comment on that?
Sure. I think the margin is a function of a few things. Firstly, as many of you may know, the CTS pricing is tiered, and as the FUM grows, the pricing comes down in basis point terms. So there's a natural flattening to some extent as the business matures. The second driver is there's been a reasonable investment in the business to make sure that it can manage the growth properly, and in part that's been associated with the investment needed for the acquisitions, but it's also partly associated with actually growing the business sensibly, and also the expansion to structured finance. So I think the observation is a fair one, but nonetheless the revenue growth outlook remains pretty positive.
And there's one more question here. Note your non-operating expenses have been lumpy over the course of the last couple of years. Have you got a comment on how they will look going forward? I might hand that one to you, Philip, as well.
Thanks, Mick. Yeah, look, sure, the operating expenses have been lumpy. They've come down dramatically over the last couple of years. We don't expect there's going to be large lumps going forward. There will no doubt be some expenses associated with M&A, although it's not possible to predict the quantum or timing of that. Although, as Mick alluded to earlier, there are a number of potential opportunities that could arise in the months and years ahead. So there'll be some, but it'll be modest, and in general we're focusing on the bottom line after all expenses. That's what's key to us.
Next question is, how applied is robotic process automation across the business? Is this a significant opportunity to continue seeing operating leverage further? Does this provide strong synergy in acquisitions? Well, there's a couple of questions there, but at this stage we've been piloting robotic processes, and we're pleased with the results that we're seeing. We do see plenty of opportunity to apply it across a broader part of the business, and I think it will produce leverage over time. Of course, we're always looking to invest in the business as well. So will it provide strong synergies in acquisitions? I think it's probably too early to tell on that final point. At the moment, our focus is on how do we apply it to our existing business, and we're seeing, as I said, material opportunities to do that. The next question is for Philip. So the second half 18 tax rate was low versus first half 18. Any guidance on the outlook would be appreciated.
Look, there's a couple of things that are impacting the tax rate just generally year on year, and to some extent half on half. Obviously the UK acquisition, there's a modest loss there at the moment. Of course that's non-deductible and has an impact on our tax rate over here. And there's also some timing issues in respect to share-based payments that also have an impact on the tax rate. So it'll just be a shade higher than it might have otherwise been that's is likely to be the case for the next year or so.
Thank you, Philip. Next question is, how difficult is it to win new CTS clients away from their existing provider? Well, look, on that list of clients that I showed, there was a couple of those that were won from an existing provider. To be honest, that is not an area of the market that we go looking at directly, but certainly clients approach us, and I think it's not difficult to change RE service provider, and it really comes down to, I think, the quality of a service and really the experience of our people, and we've got a really fantastic team of more than 30 people operating that part of the business, and all experts in fund governance, funds management operations, and compliance and the like. And so we do see opportunities for that, but many of the opportunities come to us as new startups of Australian managers, and also from new global entrants coming to the Australian market. Next question, do you have any view on the value of the WillBank in future funds under management, advice and supervision? No, look, it's too early for us to have that view, and in any event, that's not really our focus. Our focus is on providing better service to our existing clients and also looking for opportunities to cross-sell them other services. Having said that, we have put resource in over the last 12 months and development work into understanding the value of wills, and particularly focused on the new wills that we are writing. And it is an area that will continue to develop over time. That is all of the questions that we've received. Oh, sorry, one more has come in. So the underlying organic growth rate is really positive. Could you please comment on how you see a greater focus on internal sales and marketing effort could enhance this rate of growth? That's a good question, fairly broad question. I should say, so it's remiss of me to say that this pack that you're looking at this morning has been presented with our new branding in place. I hope everyone likes it. It's a bolder, more contemporary branding, representing really the way the organisation is going forward. And we wanted to retain, of course, our heritage. You see the scales there in the brand. That's important to us. But also, the strips of yellow show our energy and momentum going forward. So we're delighted with how that's been presented. So that's a comment on the marketing. But in terms of the cross-selling and the internal sales, well, it is a big focus of ours because we have a significant client base, and it's not something that we have, been, I guess, disciplined and automated about in the past. And so the digitisation of the WillBank is very helpful. We have put time, we're putting time and development effort into our CRM system to ensure that our business development people, is fully enabled as they can. We've also restructured our business development team so that part of the team is focused on the cross-selling and the internal client base. Part of the team are focused on specialist trustee areas such as the community trusts and the compensatory trusts. And part of the team are focused on our partnerships with the various private banks, brokers, and financial planning organisations and the legal fraternity. And I think that more streamlined development, together with the enablement we're doing with the platforms, will really make a big difference going forward. And that really is a big focus to get that organic growth engine working on a consistent basis in the private client side of the business. So that is all the questions now, unless any others pop up. I'll just pause for a second. It doesn't look like any more are coming through. So Philip and I will be on the road over the course of the next 4 or 5 days talking to shareholders and talking to brokers and other parties. And we're delighted that you've been able to tune in this morning and hear this presentation. And wish you all the best for the rest of the day. So thank you very much.